So CPI inflation rate came in today a little higher than expected, 8.3%. It was, I think, 8.5% last month. So Lyn, what do you make of this inflation print? And do you think that we're going to, I mean, is it temporary? Is it persistent? I know that you've been writing about this, but would love to hear you talk more about here.
So we've had a full year now of pretty high inflation levels. And once you get to a full year, kind of the monthly levels, if the month over month figures stop accelerating, like even if they stay elevated, if they stop accelerating, then year over year inflation starts to peak the way they measure it. We've already seen broad money supply peak and roll over, and now we're kind of seeing CPI start to peak. Now there's a lot of caveats there, right? So one is that that's not a perfect measure of inflation. Inflation is somewhat of a subjective basket. Everybody has their own inflation basket, and generally CPI will underreport compared to most people's inflation baskets. So we've seen, for example, there's more inflation in food and energy than in broad CPI. We still have the shelter component going up because the way they calculate it is pretty wonky, and that kind of follows with a lag. And so, we still have very stagflationary conditions, but you can have shortages mask inflation. Like I used the example before, I wanted to buy a new car, and I would have paid above asking price because I kind of need a car, a new one, and they just didn't have any of the models I wanted, and so I just didn't buy a car, right? So how do you measure that in an inflation basket, right? Basically, if those were available, if they had set prices more based on market demand, you'd see a higher inflation print, and instead it comes up into the category as declining economic activity. It's kind of like how back during the pandemic you couldn't get paper towels no matter what price you're willing to pay pretty much. Sometimes you just have shortages. And so I think for a combination of shortages and inflation, it'll be persistent, even though I think that, unless we get some more side shocks, the official year over year CPI is somewhat, peaking here. But if you see, for example, diesel completely run out on the eastern seaboard, that's very inflationary. If you see Russia completely shut off natural gas to Europe. Basically there's all these kind of, these Boolean outcomes that can spike inflation even higher, right? So I think that the Fed is trying to basically kill the demand side because they can't really do much about the supply side. And Parker's right about the credit markets. So a lot of people ask the question, how far would stocks have to fall before the Fed reverses course? And that's asking the wrong question. It's what happens with credit markets under the surface, basically those other more fundamental things, because those are the things that, if they break, the whole financial system starts breaking very quickly compared to stocks that are they're farther outside of the center of the system. They're more on the periphery. And so, for example, in late 2018, when the Fed stopped tightening, it wasn't because the S&P 500 fell 20%. It was because the junk bond market completely went illiquid. Right, so there's no junk bonds were issued for 6 weeks, and if you have a long period of that, you'll start to get company failures if they can't roll over debt and things like that. And then in late 2019, you had the repo spike. During March 2020, during that big sell-off, you had the treasury market go illiquid, right? So it wasn't even risky credit. It was just the fact that, the dollar was spiking and the foreign sector had to start selling treasuries to get dollars. And so you had more sellers than buyers, and the market went totally liquid. People hadn't really seen the treasury market break like that before. And so basically, I think that the Fed's going to tighten policy until they either start getting obvious recession indicators or something breaks in credit markets or the treasury market. And we already see, treasury liquidity is getting worse. Credit liquidity is getting worse, and so we're already kind of shaking that. And the question is, how far are they going to try to push it until something kind of snaps them back to adding more liquidity? And basically, in that kind of environment, people sell what they can, not what they want to. And so anything that's kind of perceived as a liquid and volatile asset is prone to being sold. And so there's some places to hide out in cash and things like that, but any even desirable assets are prone to these big sell-offs. So I do view this as an accumulation period, but I don't think we're out of the woods yet for inflation. And it's kind of this big trade-off between, if inflation's gonna settle down for a while, it's because the demand side's hurt, not because the supply side's improving.
It was a great analysis. And in my mind, Lyn, it's like if you have the demand side being crushed or attempting to be crushed by the Fed, and then the supply side being crushed by shutdowns in China, for instance, then if from both sides, that's sort of the the worst case scenario, right, in terms of decreasing economic activity. Okay.
Sorry, I wasn't sure who that was directed to. Yeah,
That's
basically
okay.
that's yeah.
I
So
was ambiguous.
basically, if the supply side is disrupted, you can't grow structurally, and we're not
Yeah.
seeing much of a response to those price increases, right? So for example, we're not seeing a lot of new domestic oil production come online in response to high energy prices, and so a lot of the supply side is still constrained, and then so they're stuck in either a disinflation environment if they try to just keep killing demand regardless of what happens, or if they have to relent and start giving out, like, say, fuel subsidies or food subsidies and things like that, then you get a more stagflationary type of environment. And so, those can be very troubling for risk assets. But if you look at it as liquidity play, something that can hold up is, harder monies like, gold, Bitcoin, even commodities. The advantage they have is that they don't have margins, right? So any business is being squeezed right now because they're juggling their expenses compared to their revenues. Whereas something like Bitcoin's going down purely from liquidity. But if you get liquidity returned to the market and it's still a stagflation environment, that's when you could potentially see a decoupling.